Hi, my name's Lindsay Bridgeland and welcome to this quick introduction to the Flexi 100 investment for November 2013. Now this investment's been around for many years. To those in the know, it survived the global financial crisis and we often call it the no-brainer investment, and hopefully after you've listened to this you'll see why that's the case. So first off, before we go anywhere, a general disclaimer. So this is general information only. It hasn't taken into account your personal situation and you should never invest in anything without getting professional advice. So this is quite a comprehensive slide, but it shows you the nuts and bolts of what the Flexi 100 actually is about. So we're looking at a geared investment. That means you're using borrowed money to invest. So it's exactly the same concept as borrowing money to invest in your house or borrowing money to invest in a rental property. You're using someone else's money to try and increase your wealth more quickly. It's got a choice of what investment it tracks. We have a choice of the Australian market or the Asian market. Now the investment's point-to-point exposure. Now what that means is that we look at the market on the day the investment opens, and then we look at the market on the day the investment ends, and that will either be 3.5 years down the track or 5.5 years down the track, depending on which option you choose. And if the market between those 2 points has gone up, you win, and if the market has gone down, you don't. So it's really important to understand that what happens to the market in between day one and the last day is really completely irrelevant. You're only interested in what happens to the market on the day it starts and what happens to the market on the day it finishes. And those dates are set in stone in the product when it's first opened. So during the life of the product you do get fixed income distributions. So again, those are fixed at the beginning of the product. They don't change. You know exactly how much you're going to get. And those are used to set off some of the interest cost. Now the clever bit is the loan. So this is the bit that people sometimes have a bit of a problem coming to terms with because it just seems too good to be true. But the loan is 100% protected. So that means that no matter how badly the market does, you never have to pay that loan back. There's no security required for the loan. There's no margin calls. There's no credit checks because you're never going to have to pay it back. So they don't need to know if you've got lots of money or not. And the interest rate is fixed for the term. For this particular series, the interest rate looks like it's going to be 6.75%, but that's finalised a little bit nearer to the cut-off date. So really important that you get in your head that if the markets tank and the thing's a disaster, you don't have to pay the loan. You don't get the interest back that you've already paid. You don't have to pay back the income distributions that you've received, and you don't have to repay that loan at all, ever. So the interest is also tax deductible. It's got a product ruling. You can look it up. Just pop it into Google, product ruling 2013-16. And that product ruling also has quite a detailed explanation of how the whole thing works. So if you want to know a bit more about the nuts and bolts of how it works, then have a little look through that. It's quite a good explanation. And then finally, this Flexi has got a walkaway feature. So that means that once a quarter, on a specified date, you have the option to just walk away from it. And again, you don't have to repay that loan. You don't get back the interest that you've already paid, but you don't have to repay any income that you've received. And so you may want to use that feature if your circumstances change. Let's say you lose your job and you can't pay the interest anymore, or if the markets absolutely fall over in a huge heap and you really don't think that they're going to recover by the end point. So this slide just shows the cash flows that would be involved if an investor decided to pop $100,000 into the 5.5 year class. So although they're borrowing $100,000, remember they're never going to have to repay that amount. All they need to pay is the interest. So you can see the top line there using the interest rate, which is only estimated at the moment of 6.75%, so these numbers might change. you've got the 6,750 going out every year, and then half that amount at the end of year 5, because it's a 5.5 year time period. The next line down shows the money coming in. So those are the income distributions, and those are determined at the beginning, and again they don't change. So the investor's net cash flow is the amount that you need to be able to fund from your own pocket, and that's also the amount that you would get as a tax deduction. So once you lodge your tax return, you would get a tax refund from that deduction. Now you'll see on the two last columns we've got what happens at maturity. So the first one is where the markets do well, and the markets are higher at the end than they were at the beginning, and in this scenario there they've gone up to such an extent that the gain's been capped. So the gain's capped at 50%, so the maximum the person could make would be the $50,000 at the end. So you can see that this person's made a profit of $26,625. On the final column we've got the scenario where the markets have dropped. So at the end of the term the investor doesn't get anything. So they've effectively lost the interest that they've paid to date. They get to keep the income that they've received to date, so they're out of pocket by $23,375. So not a brilliant outcome, but the good part is that they don't have to repay that loan, they just walk away. So as with any investment, there are some risks, and the risks are detailed in the PDS, which you will get a copy of before you decide to invest. But the big risk is that the markets don't perform. So as I've already mentioned, if the markets go down, you don't get anything at the end. But the good side is that you don't have to repay that loan. So hopefully that's given you some ideas as to how this actually works. And if you want to discuss it further, then just give me a call. We do obviously charge a fee for setting you up in this, but there are no fees or commissions hidden in the product anywhere. So if you want to have a look at it a little bit more, then just give me a ring.